solely responsible for its content. Josh Jelinski is the president of Wealth Quarterback LLC, a registered investment advisory firm located in New Jersey. Registration is not an endorsement of the firm or its representatives by securities regulators, nor is it an indication that the advisor has attained a particular level of skill or ability. Investment advisory services may only be provided to clients in jurisdictions in which the firm and its representatives are appropriately registered or exempt from registration. You should not assume that any discussion or information contained in this broadcast serves as the receipt of or as a substitute for personalized investment advice from the advisor. Different types of investments involve varying degrees of risk, and there can be no assurance that the future performance of any specific investment, investment strategy, or product, or any non-investment related content made reference to directly or indirectly in this broadcast will be profitable, equal any corresponding indicated historical performance level or levels, be suitable for your portfolio or individual situation, or prove successful. Past performance is not indicative of future results. Investment advisory services offered through Wealth Quarterback LLC. Tired of losing money in the stock market roller coaster? Frustrated with the government taxing you into oblivion? Worried about inflation? How do you prepare for so many financial uncertainties? Welcome to the show that will help you develop your game plan. The Financial Quarterback with Josh Jelinski. Josh is a noted financial advisor and president of the Jelinski Advisory Group, and he's here to answer your questions. Call into the show at 800-321-0710. 800-321-0710. Now, let's kick off your financial future. Here's Josh Jelinski.
Hi, everybody. This is Josh Jelinski coming to you live. Give us a call, 800-321-0710. If you have a question on stocks, bonds, annuities, mutual funds. We have special guest David Peters, founder and owner of the David Peters Financial Group, discussing with us whatever you want to talk about, folks. So give us a call, 800-321-0710. He joins us to discuss the struggling economy and challenges facing small business owners due to artificial stimulus being pumped in the economy. So good morning, David. Talk a bit about the free market and how the government involvement and artificial stimulus give only short-term bonds, short-term boosts, and don't allow the market to self-correct naturally. You want to talk about that, David?
Yeah, absolutely. So good morning, Josh. Thanks so much for having me on the show. I think that right now you're starting to see some of the theories from Milton Friedman kind of come to life a little bit, and really what Friedman kind of talked about was this idea that if government kind of interferes too much and you sort of pump too much money into the economy, that ultimately you prevent the economy from doing what it does naturally, which is kind of naturally adjust for sort of slow, steady inflation. And and I think that that's kind of what you're seeing right now. You're seeing the impact of a lot of money coming into the economy in the form of stimulus payments, in the form of forgiven PPP loans, in the form of tax incentives, and especially the advanced child tax credit and things like that. And I think you could probably argue that, at least initially, that we needed something. People were hurting, but this has gone on for an extended period of time. And so I think what you're seeing is you're seeing the impact of that. You're seeing some signs that some of the economic growth that we've seen more recently is maybe not necessarily all real. And I think a lot of financial advisors, a lot of financial professionals have kind of suspected that, but they weren't really sure. And so, but we're seeing some signs of that right now. GDP growth not being what's expected, labor shortages, supply chain disruptions, things like that.
Sustainability in what's happening right now.
Yeah, I think that's the big concern right now is sustainability, and we're starting to realize that that this is probably not sustainable, and so I think that you're seeing it in a lot of ways, and I think especially employers that are trying to hire right now, I think that they're seeing, the problems of all of this kind of very directly. They can't get the help that they need to really expand their business.
Do you have any advice right now for small business owners looking to fill open roles right now?
Well, I think that you have to make a decision from the standpoint that you have to decide, are you going to pay, the additional money that it might take to get somebody on board? I was talking to a recruiter on my podcast this past week who works in the D.C. Area, and one of the things that he was saying is he's seeing a lot of folks, a lot of employers offer signing bonuses, offer enhanced incentives, benefits, and things like that. If you're out on the job market looking for a new opportunity, I mean, it's great. But from an employer's perspective, I think you need to decide. I mean, is that what you're going to do? Is that what you need to do right now, or is the better move to just wait and to delay hiring? If you're in the small business sector and money is tight and you have kind of your hiring budget and that's it, you may have no choice but to wait.
Yeah, or you could train young, recruit maybe inexperienced people and train them.
And maybe recruiting a little bit heavier folks that are straight out of school and things like that. That can be a way to handle it as well.
Now, what do you think about inflation right now? Are we having inflation, or is it merely temporary due to the aftershocks of COVID?
I think that it's probably a combination of a lot of things. I think that you probably are seeing a little bit of over exuberance in the market. I think that you're also seeing some fear because of kind of the new Delta variant for COVID. I think that you're seeing a combination of a lot of things right now that are contributing to inflation. Including, the government, again, putting a lot of money into the economy. I think that that's what you're seeing there when generally when the government puts in a lot of money into the economy. I mean, you see higher inflation, and I think that's what you're seeing now.
Do you think we'll have deflation after the inflation? I mean, some people like Lacey Hunt, who we've had on it, has made a case that this isn't inflation, that it's actually disinflationary, because with all this spending, we've grown the economy by 6%. If you take inflation out of it, It's only a 1% growth.
Yeah, I think that's possible. Again, that kind of gets into, I think, how much of this do we actually believe is, the economy improving versus, just kind of artificial, whether that's, kind of the government kind of propping us up. And I think that that's really only something that you can, truly understand sort of after the fact. And, kind of once, the government starts to take some of these incentives run out, I think, and the economy is kind of left to kind of stand on its own.
And what do you think about the inability to fill in many demands in raw material right now?
I think it's troubling. I think, I think, that's another problem with labor shortages and things like that. I mean, all of those things are all work together, and so that's problematic, and it's making it so that the prices are going to go up, and I think that and that it's going to make it tougher for companies to control cost. And a lot of times that the only choice then is to pass that on to the consumer.
How is the supply demand connected to labor shortages, and what is the stimulus money doing to help or hurt these shortages?
Well, I think that I tend to look at my own clients as kind of just kind of as at least anecdotally information on kind of how people are feeling about the stimulus packages and things like that. And I think that because we have had multiple rounds of stimulus payments, because we've had the long periods where we've had, forgiven PPP loans and things like that, the things that I mentioned earlier, I think that people are starting to get used to them. And I think that I think that in of itself is making it so that maybe there's less incentive right now, to do the things that our economy would do naturally. People, going out and trying to go out and find jobs. They can, where we talked about how the employers are kind of doing whatever they can to get people on board, but people aren't quick to land and quick to sign on, and so I think that you're seeing this problem continuing to compound. And again, I think a part of it is it's habitual. It's people are kind of used to the stimulus, the stimulus payments, the payments that the kind of the easy to get money. But point to another Milton Friedman quote: "There's no such thing as a free lunch," and that's one of his probably his most famous one. And I think that again, you're starting to see that right now.
Do you think we'll see a correction as the unemployment benefits come to an end?
Yeah, I do. I think that, I do think that we are going to see a correction. And I think that, as unemployment benefits end, as government programs tail off, I think we're definitely going to see that. And I think a lot of financial advisors, either, sort of outwardly or kind of more inwardly have also said that. I mean, they have at least thought that that this is kind of almost too good to be true. The market's been up, and so for the most part, and so I think that there is this idea of regression to the mean, and so if markets are kind of going too hot for an extended period of time, the professional skepticism kicks in, and we kind of all think to ourselves, okay, when does the correction happen?
And what are you telling clients? Now, I know we're not giving any financial advice, but what are you telling clients to protect themselves in these uncertain times?
Well, I think that a lot of my clients are retirement planning clients, and so we're looking over the long term anyway. And so, especially when you're planning for retirement, and it's long time periods, longer term investing. It's the message is often is that to not be sort of too quick to react to sort of day-to-day and short-term movements in the market. I mean, with retirement planning especially, I mean, we care about getting from where you are to where you want to be in retirement. And the stuff in the middle tends to be just kind of noise. It's it's just kind of movements in the market. Markets are going to go up, markets are going to go down. But ultimately, we're kind of still aiming towards the long-term goal of getting people to retire in the ways that they want to. And so, for a lot of my clients, right now, it's we're trying to figure out whether or not our long-term strategy still works. And trying not to sort of overreact to the short-term market movements that we've seen.
Great. Thank you for joining us. David Peters, DavidPetersFinancial.com, DavidPetersFinancial.com. Thank you for joining us. And folks, when we return, we'll be back with your questions all hour at 800-321-0710 and a listener email I'm going to answer when we return. This is Josh Jelinski, the financial quarterback. Don't touch that dial.
It's always on your mind. Retirement, whether you're 55 or 35. Not everyone wants to work forever, and most would like a comfortable retirement. You may already have a plan, but is it the right one? Josh Jelinski, host of the popular Financial Quarterback radio program, is ready to guide you towards financial freedom. He challenges the ways your parents and grandparents saved money with fresh strategies, which are exactly what you need to navigate today's volatile economic climate. Josh's new book, Retirement Reality Check, is available to order on Amazon. It's an easy read that guides you through his system for securing your financial freedom, including tax-saving strategies, understanding the right investment mix, and more. Order now. Retirement Reality Check. Call Josh at 888-988-JOSH. Let Josh help you map out your retirement using fresh strategies. Call 888-988-5674. That's 888-988-5674.
Hey, meet you out on the first tee?
Yeah, I'll be right there. Just reading this article.
On what?
New bill Congress passed. Looks like it's going to affect the value of all retirement savings plans. My financial guy didn't tell me about this when I saw him the other day.
Well, my guy did, and we made a plan. You may have heard of him, Josh Jelinski.
Josh Jelinski is your guy?
Listen, if you're 10 years or less from retirement,
Which I am.
Josh will give you a free economic plan, which includes retirement planning, a 27-point checklist to make sure your income lasts as long as you live. He'll even help you navigate the current tax code.
I'm definitely going to call Josh.
Cool, but first, can we play some golf?
Call Josh Jelinski, host of the popular Financial Quarterback radio program, for your free economic plan. 888-988-JOSH. 888-988-JOSH. 888-988-JOSH.
Hi, everybody. This is Josh Jelinski. We're going to be talking about the supposedly bipartisan, I don't know about that, infrastructure deal advanced to a Senate 67-32. Well, that really isn't bipartisan, but it was above the 60-vote threshold needed. How will this impact economic growth? The nation's budget, I guess two-thirds, I guess you could say it's two-thirds of the Senate. I guess you could call it bipartisan. But why are we spending roughly $1 trillion more? What happened to all the stimuli of last year? How will this impact economic growth, the nation's budget and deficit? And ultimately, how might this profligate spending impact inflation and your finances? And Think Advisors' Harry Stout gives 7 reasons why annuities all of a sudden have more value in 2021. And WAPO, Washington Post, says how to attract and retain employees in a shifting job market for our small business owner clients. And Kiplinger, not even half of U.S. states offer financial literacy classes in high schools. So parents have to pick up the slack. You got to make your kids listen to this show or watch the YouTube. We're going to give you 7 tips to teach investing for kids. And one of the 7 tips I found helpful was to pique their interest with companies they know. Your kids know Amazon, they know Facebook, they know Google, they know Apple, and Samsung are just some of the companies that come to mind. But first, the bipartisan infrastructure deal. How will this impact economic growth? So let's talk about that. So profligate spending will ultimately cause transitory inflation, which is what is happening now, not real long-term sustainable economic growth. And generally, as has been shown by the Great Depression, if we spend a lot of money, it will prolong any recession. And I think professors at like Cal Berkeley found this out. Like, it wasn't like a conservative think tank. With all this volatility in the economy, some takeaways: set up a volatility buffer. So a lot of you are worried about the market. You have a tinge of greed too. You're like, well, why is my portfolio only up this amount? Well, maybe it's because a volatility buffer was set up. Now, if you don't know what a volatility buffer is, I'll tell you. It's a large chunk of money in cash, fixed annuities, bonds, bond ladders, cash value and life insurance that you could go to if there is a crash to keep that long-term perspective. And we may not have a crash. We may have a 10% correction even this year, just as a kind of a breather of what's going on. So the Biden infrastructure deal, which, I thought people were supposed to be the party of fiscal responsibility and restraint. And we're not seeing any political party be for fiscal restraint at all. So then there's an article, 7 reasons why annuities have more value in 2021 than they did maybe before. Older investors have gains to lock in. High income investors have taxes to manage. So basically, maybe the tax deferral is a good thing. So give us a call, 800-321-0710 if you have a financial question. 800-321-0710 if you have a financial question. Now is the time to chime in. 800-321-0710. Now the article states this: the need for sources of protected lifetime income. Individuals cannot find sources of protected lifetime income that annuities can provide. The number of individuals with pensions continue to decline. So one of the reasons why annuities may have more value in 2021 is as a pension replacement. Also, risk management. Annuities are an insurance product, and this is becoming better understood, whether to protect principal, create income streams, or to take advantage of supplemental long-term care. So let's say you want long-term care insurance, but you are not healthy enough to get it, or you don't want to pay for it. Some annuities have long-term care benefits that you could get that would help pay for a live-in nurse when you're, of an older age and you need help bathing or dressing or eating, and you don't want to get shipped to a nursing home. We all know what happened last year with many who died. Many of the COVID deaths were people stuck in nursing homes. And death benefits, these products are insurance. One use that is increasingly common is to trigger guaranteed income as a hedge against sequence of returns risk for other equity assets. So what does that mean? Let's say you have $500,000 saved for retirement and you want $1,000 a month as income, but you're worried that if the market goes down, that's going to cause your 401k to become a 201k. Maybe you take $200, buy an annuity with that would produce an income of $800 to $1,000 a month, depending on age and other variables. Then you take the other $300, and you could be in a diversified portfolio of low-cost ETFs, also individual stocks. Right now, as indexes are up too, there are some great deals in the stock market. Some stocks are actually on sale. And we have an individual stock portfolio where we're seeing very good deals. So don't get a case of indexitis, meaning so many people, the index. Look at your portfolio and see if each constituency has value and merit. Call us at 888-988-JOSH, 888-988-JOSH, and we will review your portfolio at no charge, 888-988-JOSH. One use that is increasingly common is to trigger guaranteed income streams, also to protect equity market gain. Older individuals who have done well in the equity markets are looking for ways to lock in gains they have generated. Let's say you had $2 million a year ago, now you have $3 million because you took a lot of risk. Maybe take $1 million off the table. Maybe you had 500, now you have $1 million, whatever it might be. Maybe you have 50 grand, maybe now it's 200. Maybe it's time to protect some equity market gains. People who've done well in the equity markets are looking for ways to lock in gains that they have generated. Moving the money from pure equity products into most types of annuities protects their principal, including the gains. That's if you have a fixed annuity as opposed to a variable. So I'll go through the 7 reasons why annuities have more value. Number 1, the demographic steamroller continues. People are turning 65 at the rate of 10,000 people per day. 16.5% of the population is now 65 or older. So there is a growing age cohort of people moving from accumulating assets to protecting what they have and generating the most income from their capital. Also, the desire to protect equity market gains. We talked about the Biden infrastructure deal, not really, the market went up the last so many months, but since May, it's been stagnant. It's been like this. Hover around that 35,000, then it's down to 33.5, then it's up to 34.5. Then, so the Dow keeps it's like a yo-yo since May. What is the market telling us? Maybe people are concerned because of all this spending, all the potential inflation. Maybe you're concerned about your portfolio. Give us a call, 888-988-JOSH, and we will review it. So if you go into reasons why an annuity has more value in 2021, other individuals who have done well in the equity markets are looking for ways to lock in gains. We talked about this earlier. Moving money from pure equity into certain fixed annuities protects principal, including the gains generated over the last year or two. Tax deferral. One of the intrinsic values of annuity products is the tax-deferred buildup of accumulated interest. With income taxes likely to rise due to the Biden tax hikes, tax deferral is a very valuable characteristic that is often neglected. Number 4, risk management. Annuities are an insurance product, and this is becoming better understood. Here's the thing, the purpose is not growth. So some of you've accumulated enough money to be okay for the rest of your life. Why screw it up? And although we're not recommending you put all of your money in an annuity, why you should do your due diligence, seek to understand the internal fees, how long you have to hold it, all of that stuff, you may want to consider it as a way to take advantage of the benefits that I talked about: income, long-term care, and death benefits. Number 5, I said this before, but it's worth mentioning again, protected lifetime income. Many of you do not have a pension, and you need one. With interest rates on long-duration fixed income investments at record lows, annuities have become a more attractive tool. You used to be able to get a Ginnie Mae fund for 5%. Same Ginnie Mae fund's paying 1%. Annuities have better yields now than the old Ginnie Mae funds or even a treasury fund. We'll give you the 2 more benefits of an annuity. But first, we're going to go to the phone lines when we return from the break. So we'll talk about the 2 more reasons annuities might have value. And then we're going to go to Jerry, who seeks a better mutual fund. So we'll be back after these messages. This is Josh Jelinski, the financial quarterback. If you have a question, call us now, 800-321-0710. Don't touch that dial.
Are you worried about the recent coronavirus crisis and how it may have affected your money? Hi, everybody. I'm Josh Jelinski, the financial quarterback, inviting you to join me for my complimentary 6 Ways to Keep Calm During Turbulent Markets webinar. If you schedule and keep your no-obligation webinar today at 888-988-JOSH. It's a great thing to do. If you're stuck at home under stay-at-home orders, call us right now, 888-988-JOSH. If you're bored, there's never been a better time to get a second opinion on your wealth than right now. 888-988-JOSH, 888-988-5674. And go to my website, retirementrealitycheck.com today and take your free investment profile quiz. And when you buy my book, you're eligible for 3 free gifts. 888-988-JOSH.
Call Josh Jelinski, host of the popular Financial Quarterback radio program. 888-988-JOSH.
Next up, Jerry with a question calling us on our listener call-in line at 800-321-0710. Go ahead, Jerry.
Yes, I'm 80 years old, and I have a 12-year-old daughter and a 19-year-old son, and they're going to inherit the $500,000 that I have in the S&P 500. But the problem is I keep having to pay taxes on that roughly $6,000 in dividends. Is there anything that does as well as the S&P 500 without the dividends and a mutual fund or something?
Well, number one, you could call us at 888-988-JOSH for the free review. Number two, you can buy index funds within tax-deferred annuities now. There's a whole category of no-load or investment-only variable annuities where for a small fee, sometimes they're as little as $20 a month, you can get tax deferral. So all those dividends that you don't like paying taxes on, which is essentially you're paying taxes on money you're not spending. So you could buy the same index fund within a tax deferred annuity, number one. Number two, you could look for high quality individual stocks that don't pay a dividend. So there are, if you think about Warren Buffett, his stock does not pay a dividend. Now, in full disclosure, I own it. And that's one reason for it, because I don't want to pay taxes on money I'm not spending. But, with anything, there's risks. You want to be careful. Then you want to look at maybe tax favored investing. So there are tax managed mutual funds where they try to mitigate that. You could also look at Roths. You could look at cash value and insurance grows tax-free and can be pulled out tax-free via a policy loan. So there are a whole host of options for you. You could also look at one of the big keys here is to not pay taxes on money you're not spending. So we mentioned investment-only variable annuities. Now those have the risk of the stock market, but so does the S&P. We mentioned Roths. We mentioned cash value life insurance. We mentioned stocks that do not pay a dividend, and we mentioned tax-efficient ETFs or mutual funds. So those are five things you may want to consider if taxes are getting you and your portfolio down. And also come in for the free review. We'll go over that at 888-988-JOSH for the 45-minute financial strategy session. So any other questions, Jerry, along that line?
No, that sounds good. I'll have to I recorded what you told me, so I'll listen to that a few times. So.
Now the one consideration you want to have is with an S&P 500 fund, you have considerable risk in the market. And the indexes have done well, but in March of 2020, they were down significantly. So you have to be okay with the amount of risk you're willing to take, which seems like the risk is pretty high. And although the indexes have done well, except for like March of 2020, since the 2008 crash. And the 2008 crash, people lost, 40, 50% in index funds. So you have to be very careful. The other thing you want to be mindful of is if you have significant gains, for you to go into something that's tax-free, you might be paying capital gains. But if you can avoid those, $6,000 tax hits every year for the next, 10 years, you may also want to buy, do a gifting strategy so your kids can then have tax deferral. So you may want to set things up in their name. That way, maybe they're paying the tax at a lower bracket. So I hope that helps, Jerry. I'd love to meet with you at 888-988-JOSH. Next up, we have Rose Marie, who is trying to choose an annuity. Go ahead, Rose Marie.
Yes. Hello, Josh. Yes, I'm looking to lock in my investment into an income annuity because the investment that I was in, they suspended the dividends the last 15 months, and now they're not going to give it back. So I want to get out of that and lock in my income in an income annuity. What do you recommend? I don't know anything about annuities. Is there a fee to get into them? And is it revocable, or once you put your money in, and can you ever take it out?
It's a great question. Number one, there are irrevocable ones and there are revocable ones. So you want to be careful when you're choosing to ask that question. You also want to look at the fees. There should be no fees to get in, although I guess there are on some. Generally, there are internal fees and external fees. Internal fees would be an expense ratio on a mutual fund, for example, in a variable annuity. You might pay an income for life fee. Or there are annuities that have no fees, such as fixed annuities, fixed indexed annuities, or immediate annuities. Now, typically, you pay a fee for a rider. So, for example, if you buy a fixed annuity, With an income for life rider, you may pay a fee of approximately 1%. That 1% may buy you a guaranteed monthly paycheck and not forcing you to annuitize, which means when you die, the asset doesn't die, it goes to your heirs. So the two biggest knocks on annuities are irrevocability. That only is with reference to what are known as immediate annuities. Most annuities have a term or a time period that you have to commit to. For example, 3 years, 5 years, 7, 9, 10, as high as 14 or 16 years. But after the end of the term, let's say you do a 10-year annuity, after 10 years, the money's fully liquid. If you do a 12-year annuity, after the 12 years, it's fully liquid. If you do a 5-year annuity, it's fully liquid. So you can choose the number of years you have to hold it. You can buy a no-fee annuity or a very low-fee annuity. You just got to shop around just like anything else. And we have an annuity shopping service. If you call us at 888-988-JOSH, where we could, we get your age, we get the state you live in because they're state dependent, and then we look at your criterion, whether you want fixed indexed, immediate, or deferred. Does that make sense?
Yes.
So generally, and then there's basically the time period, the fees, and what type. So time period, fees, and what type. Those are the three biggest questions. And then what we do is we'll show you a printout of the top three in your category based on our shopping. So that way you can pick. We shopped around, so you don't have to feel, like you didn't do your due diligence. Does that make sense?
Yes. Is that service free, or is there a charge for that?
Well, there's no charge for the 45-minute strategy session where we'll shop it around and show you different things. No.
Okay. Would it be possible for me to mention the two insurance companies that I'm interested in, or not?
No, we would prefer you handle that in the in-person meeting, just because I don't want to give, unless they're advertising on the show, or we don't want to besmirch a particular company over the air. So
I see.
If I don't particularly like the annuity, but if you call us for the 45-minute strategy session, we'll do that for you at no charge. Okay.
When should I call?
Oh, call us now. 888-988-JOSH. We have clients there right now.
Okay. All right. Thank you very much.
Yeah, we also have staff picking up the phone lines. They do a great job every week. David, Rich, Jim, and the team are there right now at 888-988-JOSH. And, just like the beautiful thing about our shopping service is you tell us the criterion. Now, you may not even know the criterion, but then we'll educate you. Okay, here's a fixed, here's a variable. Variable, your money is in the market, but you're paying extra fees for guarantees. Fixed, you're paying no extra fee. It's just, you make 3% for 5 years or 2% for 5 years or whatever the going rate is on annuities right now. And then fixed indexed is kind of like a hybrid where it's principal protected, but the interest that you earn is credited based on the performance of an underlying index. And then there's immediate, which they just give you monthly checks in exchange for typically irrevocability. However, there are ones that have a 10-year out clause in some of them, and we can talk to you about those. But don't throw the baby out with the bathwater when buying annuities, because some people say, oh, you're tying up your money forever. You don't have to. Oh, there are high fees. You don't have to. So just like anything, there are high-fee mutual funds and low-fee mutual funds. There are high-fee annuities and low-fee annuities. So it's a tool, generally for conservative income. So thanks so much for calling, Rosemary, and I hope to meet you soon. So folks, the final two reasons why annuities have more value is life innovation. Insurers have brought new product structures to the market, new strategies, products focused on the needs of the RIA community, now that are more fiduciary friendly, and adding innovation features such as long-term care benefits and the ability to pay for advice from the annuity product without triggering income tax. That used to be one issue. And then finally, leveraging product efficiencies. So when purchasing an annuity product, the buyer is receiving, this from Harry Stout, is receiving the professional asset management capabilities of a life insurer, asset liability management expertise, actuarial knowledge, and mortality credits from insurers having large books of business and state-based solvency regulation behind the capital the insurer has deployed to support the business. So there's a lot of benefits there: tax deferral, flexible income, limited liquidity, accumulation provisions, and payout guarantees. So with historically low interest rates, if you're looking for ways to get more yield, call us at 888-988-JOSH, 888-988-5674. We'll be back after these messages.
Josh Jelinski, the financial quarterback here. In these uncertain financial times, it is imperative that you guard your financial future. If you call within the next 3 minutes, we will offer our complimentary bear market survival guide, which will detail steps to help your plan to potentially survive the COVID-19 crisis. The bear market survival guide will cover how you might still be able to retire amid a volatile economic climate. We will throw in our complimentary 27-point ultimate game plan for retirement. Call us at 888-988-JOSH, 888-988-5674 for your bear market survival guide.
Call Josh Jelinski, host of the popular financial quarterback radio program, 888-988-JOSH, 888-988-JOSH. It's always on your mind. Retirement, whether you're 55 or 35. Not everyone wants to work forever, and most would like a comfortable retirement. You may already have a plan, but is it the right one? Josh Jelinski, host of the popular financial quarterback radio program, is ready to guide you towards financial freedom. He challenges the ways your parents and grandparents saved money with fresh strategies, which are exactly what you need to navigate today's volatile economic climate. Josh's new book, Retirement Reality Check, is available to order on Amazon. It's an easy read that guides you through his system for securing your financial freedom, including tax-saving strategies, understanding the right investment mix, and more. Order now. Retirement Reality Check. Call Josh at 888-988-JOSH. Let Josh help you map out your retirement using fresh strategies. Call 888-988-5674. That's 888-988-5674.
Americans have saved a lot of cash when it comes to household finances. From CNBC, a third of Americans say they got better with money during the pandemic. Did your personal, I'm going to throw out this listener question. For those of you who want to call us, chime in now, 800-321-0710. Get to ask me any and every financial question you have. Did your personal circumstances during the COVID lockdowns make you a better money manager of your family's finances? And some tips. Cash may be king, but don't forget good old-fashioned investing and portfolio management and life insurance and tips for financial planning. So you may have accumulated a lot of cash now because of stimulus money. Some people just threw that into stonks, those, meme stocks, and they forgot basic financial planning 101. If you have cash, you need to prepare for death, disability, and the loss of income. And what some people are doing is they're using cost segregation to buy maybe an investment property or something like that. So there's a lot of tips when it comes to cash. So 32%, this was according to Northwestern Mutual's recent 2021 Planning and Progress Survey, 95% said they expect to keep it that way. The annual survey conducted by the Harris Poll includes responses from 2,300 adults during a 10-day period in March of 2021. The survey found that nearly 1 in 5 did not have a financial plan before the pandemic struck, but 83% of Americans say they either created, revisited, or adjust their financial plan during the pandemic. The most common habit survey respondents developed is reducing their living costs and spending, with 45% of respondents saying they adopted this habit. The second most common habit, which 34% of survey respondents say they adopted, is prioritizing paying down debt. In 2020, Americans paid a record $82.1 billion off of their credit cards. They've paid another $56.5 billion in 2021. So essentially, the COVID stimulus made credit card companies richer. So they got all their debts repaid. Many Americans also started investing more, with 33% adopting the habit of investing during the pandemic. But paying down debt and investing are not the only adjustments Americans are planning to make. The survey found that 25% are considering increasing their savings and retirement contributions. Of course, there are still many downsides. The COVID deaths, and nearly half of Americans, 45%, say the pandemic has impacted their timeline to reach financial security by 1 to 2 years, with 35% delaying making any large financial or life decisions. While improvements in financial habits are positive, it should not overshadow the fact that adjustments are coming from a place of financial difficulties for many. So there's also a phenomenon called revenge spending. So people are just spending more and more on their vacations because of the revenge spending. So give us a call, 888-988-JOSH, 888-988-5674. Make sure you subscribe to our YouTube. Go to youtube.com and search for my name, Josh Jelinski, the financial quarterback, and hit the subscribe button. Give us a call, 888-988-JOSH. We'd love to hear from you. Now, they didn't expect to retire early. The pandemic changed their plans. More and more Americans are retiring early, but do they have a plan? So one of the things that we help people with as they're planning is how you can go to a lower tax bracket in retirement. A lot of you are taking money out of your 401ks and IRAs. You don't know about Medicare. You don't know how Social Security works. You need a plan. Also, have you protected your money from the nursing home or Medicaid spend down? And have you organized your estate planning documents? Write a will, a living will, establish a revocable trust, deeds and ownership agreements. And think about, if you have all this money in an IRA, how are you going to get it out with as little tax as possible in retirement? Some of you are marrying now in retirement. Make sure you maybe consider a prenup. But if you go from single filing taxpayer to married filing taxpayer, you might save some significant money on taxes. So folks, give us a call, 888-988-JOSH. If you are retiring early or thinking about retiring early. And up next, we're going to talk about how to potentially attract and retain employees in a shifting job market, and 7 steps to teach kids on how to invest. So the current job market is favoring employees as employers struggle to fill a spike in demand as a result of the post-pandemic reopenings. Compensation and benefits are just a couple of ways that employers are attracting and retaining the right people. We're also helping many employers look at pensions again, look at a 401k, 457, 403b, and also maybe a profit sharing plan. That way your employees you're able to attract and retain the right talent. Give us a call, 888-988-JOSH. And we'll help you how to do that. And we'll take your calls at 800-321-0710. If you have a financial question for us, call now, 800-321-0710. We'll be back after these messages.
Hey, meet you out on the first tee?
Yeah, I'll be right there. Just reading this article.
On what?
New bill Congress passed. Looks like it's going to affect the value of all retirement savings plans. My financial guy didn't tell me about this when I saw him the other day.
Well, my guy did, and we made a plan. You may have heard of him, Josh Jelinski.
Josh Jelinski is your guy?
Listen, if you're 10 years or less from retirement,
Which I am.
Josh will give you a free economic plan, which includes retirement planning, a 27-point checklist to make sure your income lasts as long as you live. He'll even help you navigate the current tax code.
I'm definitely going to call Josh.
Cool, but first, can we play some golf?
Call Josh Jelinski, host of the popular Financial Quarterback radio program, for your free economic plan. 888-988-JOSH. 888-988-JOSH. 888-988-JOSH.
Okay, we're back. This is Josh Jelinski, the Financial Quarterback, coming to you live, taking your questions on all matters financial at 800-321-0710. And if you want the no obligation 45-minute income for life strategy session, call us now, 888-988-JOSH. We're talking about how to attract and retain employees in a shifting job market. A record 44% of small businesses were unable to fill jobs. So consider putting together a 401k, and you might get a tax break to do it. Consider providing a pension for your company. Not many people have that nowadays, and that's a lot what people want. So give us a call, 888-988-JOSH. So many of you are business owners looking to improve retention, and the retirement savings plans can really be a way to help your employees and to help yourself in these uncertain times. Also, 7 steps to teach kids how to invest. Number 1, include kids in financial conversations. Number 2, teach kids investing is not a get-rich-quick scheme. That's a big one that in the Robin Hood culture we have to stop. Number 3, help kids start investing with a financial goal. Say they want to save up for a doll. Our girls used to do that, and they still save up for various things. 4, explain the power of compound interest. Do you know a dollar doubles every 10 years at 7.2% interest? So learn about the power of compounding. Also, talk about companies they know. We mentioned this earlier. And experience investing firsthand. Many programs, and we can show you how to do this, we can teach your kids about virtual stock markets or virtual trading of accounts where you can trade like paper trading, where it's not real, but they get to see, well, what would happen if I bought this? That it's not just a get-rich-quick scheme, but it's about opening real investments accounts with real money, and now sometimes investing in low-cost indexes and high-quality individual stocks are a better tool than, the stonks or the meme stocks like GameStop and all these other ones that people crowded into in January. So folks, give us a call now, 888-988-JOSH. Next hour, we're going to be talking about the Retirement Security Task Force, vaccine-mandated retirements, and states that cut unemployment early aren't seeing a hiring boom, and why that could spell potential negatives for your portfolio. So what's happening is we're seeing the beginnings of what Lacey Hunt calls the disinflation. So with all this spending, the economy is only growing by 6%, 5% inflation. So we have 1% real growth with basically like 8 to 10 trillion that was created over the last year due to the pandemic, year and a half. So what is going to happen? Our dollar is going to devalue. The value of your retirement accounts are going to buy less. In essence, inflation is stealth taxation. So what do? You get a plan, call us, 45-minute strategy session. We'll give you a second opinion on your portfolio. We'll also give you tips if you call me right now at 800-321-0710. And if you call us within the next 3 minutes, we will give you the Income for Life Blueprint at no charge when you schedule and keep your no obligation 27-point ultimate financial game plan for retirement. We go over asset protection strategies, tax saving strategies, and growth strategies for these uncertain times. So call us now, 888-988-JOSH, 888-988-JOSH, and teach your kids how to invest. Use these tips. Also, make sure you are not throwing out the baby with the bathwater when it comes to financial products that might protect your family. But make sure you teach your kids to invest. Make sure you focus on income planning in retirement. And make sure you are mindful of risk. Because even though the market's up, it could go down. And some of you have accumulated enough to where you're okay. You don't need to take excessive risk in your portfolio. You could set up a volatility buffer. So call us now, 888-988-JOSH, 888-988-JOSH. Now this was interesting. In a recent survey from financial services firm D.A. Davidson, 1/3 of respondents said children should start learning financial literacy at age 10 or younger, yet less than half of states in the U.S. require high school students to take a personal finance class. Although, to be honest, I don't know if I'd want to be, I don't know if I necessarily want to be learning finance from my high school teachers. No offense, high school teachers. If you're listening, give us a call, 888-988-JOSH, 888-988-5674, 888-988-JOSH for the no obligation 45-minute ultimate financial game plan, 888-988-JOSH, 888-988-5674.
WOR and WAXQ HD2 New York, an iHeart radio station. Available everywhere on our free iHeartRadio app. Number 1 for music, radio, and podcasts.
Relaunch, restart, recover. This is where New York comes for everything you need to know. The voice of New York, 710 WOR.
An iHeart radio station.
And we've got 64 degrees at 10 o'clock. Good morning, I'm Paul DeCastro. An NYPD lieutenant is recovering after being shot in the ankle during a fight with a suspect overnight in the Bronx. It happened around midnight at Lyman Place and East 169th Street. The lieutenant and 3 other officers assigned to combat gun violence followed a man they believed was armed and got into a struggle with that suspect, who apparently fired one shot and hit the lieutenant in the ankle. He was treated and released at Jacoby Hospital, is expected to make a full recovery. The 3 officers suffering minor injuries. The suspect was arrested and a gun was recovered. Police say 2 men stabbed another man several times and left him to die in a Bronx driveway Friday night. The victim, 35-year-old Jesse Jackson, was found dead in front of a 2-story home on East 227th Street near Barnes Avenue in the Edenwald section just before 7 p.m. Cops say the victim was chased down by the suspects before they stabbed him to death. Jackson was pronounced dead at a nearby hospital. It's unclear what led up to the attack. No arrests have been made, and the investigation is ongoing. Minimum wage in Connecticut is going up tomorrow. Ashok Bala with more.
Governor Ned Lamont signed legislature back in 2019 that'll cause the current $12 an hour to go up to $13. Another $1 will be added in July of 2022, and on June 1st of 2023, it'll be $15 an hour. When the governor made the changes, the state minimum was $10.10. Starting at the beginning of 2024, the Public Act will require the minimum wage to become indexed to the Employment Cost Index, which is calculated by the U.S. Department of Labor. That will cause the state's minimum wage to rise, according to economic indicators. Ashok Bala, WOR News.
At the Olympics, the United States tied for the most medals as they have taken home 46, 16 of them gold, 17 silver, 13 bronze. China also with 46 medals. They lead the way in gold with 21. In men's basketball, Kevin Durant of the Nets, of course, scored 23 points as Team USA slammed Czech Republic 119 to 84. The Americans advancing to the quarterfinals. Baseball last night, the Yankees over the Marlins 3-1. Anthony Rizzo homering in his Yankee debut. Joey Gallo also making his Yankee debut. He was hitless. The Mets, meanwhile, falling to the Reds 6-2 at Citi Field.
Here's your WOR Weather Channel forecast. Dry on this Saturday with comfortable temperatures as the high heads to 77 under a sunny sky. Overnight clear, the low of 65. Clouds will increase on Sunday and some showers may develop later in the afternoon with a high of 79. More rain Sunday night with a low of 65. Then a clearing trend for the start of the week on Monday with a high in the low 80s. I'm meteorologist Jeff Marr.
Next news at 11. Start your day with Len Berman and Michael Rito in the morning, 6 till 10 weekdays. I'm Paul DeCastro on 710 WOR, an NBC News radio station.
Tired of losing money in the stock market roller coaster? Frustrated with the government taxing you into oblivion? Worried about inflation? How do you prepare for so many financial uncertainties? Welcome to the show that will help you develop your game plan. The Financial Quarterback with Josh Jelinski. Josh is a noted financial advisor and president of the Jelinski Advisory Group, and he's here to answer your questions. Call into the show at 800-321-0710. 800-321-0710. Now, let's kick off your financial future. Here's Josh Jelinski.
We're back with listener questions all hour. This is your show, folks. You get to ask me any and every financial question you have. You go to the youtube.com/Josh Jelinski, the financial quarterback. All you have to do really is go to youtube.com, type in the financial quarterback in the search menu, Josh Jelinski, the financial quarterback. And basically, you'll see my ugly mug, hit the subscribe button, and you get to watch the over 148 videos that we have. And you get to ask me any question in the chat box, and we'll answer it. But first, we're going to go to our listener questions at 800-321-0710. Go ahead, Mary.
I would like to know, if a stock splits and you own it, do you really gain anything?
Are stock splits good or bad?
Yes.
Well, splits are often a bullish sign since valuations, this from Investopedia, get so high that the stock may be out of reach for smaller investors. So it's a way for you to kind of like, they do that with Apple. Kept getting high and they keep splitting it. Did that with Tesla. So investors who own a stock that splits may not make a lot of money immediately, but they shouldn't sell the stock just because it's split. I mean, in reality, it's worth the same whether it's split versus when it didn't. You know what I'm saying?
But then you have more stocks, and then the stock go up. Eventually, the stock will go back up. So wouldn't you gain by getting more stock?
Theoretically.
That's what I think.
Could be a sign of the top, though. I mean, meaning it really doesn't. It doesn't matter, except it might allow smaller investors to get in, which would be a bullish sign. Does that make sense?
Yeah.
It could also be a sign of a top, though.
So when Apple was going to split, they kind of notified everybody. So then my question is, if I didn't own Apple stock, which I did not, unfortunately, and then you heard it was going to split, and then there was a dip in the market, and then you bought the Apple stock, and then the market came back, wouldn't you make out that way or no?
You could. Depends. It just, generally it's thought of to be a bullish sign, which is good for the stock.
In your opinion, is Apple a good stock? I think it is. It keeps going up.
Well, it has been a great long-term holding of the last, but long-term depends. If you bought Apple stock that lost decade they had in the 90s, that depends. Depends if they keep innovating, right? That's the key. Will a company keep innovating? Think about Microsoft, right? It was the stock of the 90s and then did nothing from 2000 to 2010. The last decade has been very good for both Microsoft and Apple, but it doesn't mean the next decade will. But as far as the stock split, it's thought of to be a bullish sign, but it's really like if you have a $10 bill and I give you 2 5s, it's the same thing.
Oh.
It's not like, it's not supposed to be bullish. In the case of Apple, though, it was very bullish because now everybody who wanted to buy in could afford it, or before they couldn't. It was getting too attainable. It's like Amazon. Amazon's $3,000 a stock. They may inevitably split because people go, wow, buying some Amazon too expensive. That was maybe a bad idea that they didn't split. Does that make sense?
Yes.
So, but Amazon still went up. So, so it really was irrelevant. But in the case of Apple, I think it's really smart because it allows regular people. I don't know how many splits they've had. They've had a ton. So, and it probably would have been good for Amazon to split. But, generally splits are thought of to be bullish and reverse splits are thought of to be negative, even though theoretically it's the same dollar amount. A reverse split is when you have two $5 bills become 110. So it's one of these things where it doesn't matter, but like you're right in saying it's probably more of a positive thing for sure. So any other questions, Mary?
No, thank you so much, Josh.
Great call. And next up we have Bob. Trusts for IRAs. Go ahead, Bob.
Good morning, Josh. I have a question. Can a testamentary trust be set up as the beneficiary of an IRA? Since the trust doesn't really exist until the person's death, how would you go about doing that?
Well, I don't know. Why would you want to do that?
So that my minor grandchildren would not receive large lump sums of money. We would want it distributed at certain ages.
But they have the 10-year rule. Unless they're minor children of the new Secure Act. Yeah, that's not something you should do just lightly, because it may trigger income taxes when the money goes into the testamentary trust. It may be better to just leave them as the beneficiary on the account.
Why would it generate the tax when it went into the trust?
Well, because
wouldn't it be the same as if it went to the individual child's name?
No, when you go to an IRA, when an IRA cannot be owned by a trust. Now, there are IRA trusts. There's a whole, you need a good financial advisor. You need a good attorney to set it up right, what you're trying to do. It's not as easy as one might make it, especially with the Secure Act. Does that make sense?
Yes, I know the Secure Act complicates it a lot.
The reasons to name a trust are generally to control and manage post-death IRA distributions. They were more necessary when there was the stretch. You could do what's called the multi-generational IRA trust. You can still do that with the Secure Act, but it is much more cumbersome. But, a testamentary trust, the trust would have to have certain provisions. It has to qualify as what's called a see-through trust in order for it to be counted for what you're trying to do.
Okay, so there is a different kind of a trust, which is an IRA trust, and I should investigate that.
To be clear, people call it different things. So, and the rules before the Secure Act pass versus after, there's conduit trusts, there are discretionary trusts, there are different types of IRA trusts. There's a whole host of issues with IRAs and trusts that I don't want to bore people. But basically, the reasons to name a trust would be to ensure the 10-year stretch, or if they're really young, where they could take advantage of the new Secure Act. You could fund charitable bequests. You could secure state estate tax exemptions. The reasons not to name a trust are complexity, many tax rules to follow, costly to create and maintain, annual tax returns and administration, high trust tax rates, no separate account rules, and required minimum distributions are based on the shortest life expectancy typically. So the benefits of the see-through or look-through trust, which is what you need an IRA to be, this from Ed Slott had a nice document, which was a few years ago. So I would get it, I would call us at 888-988-JOSH for the review. And then we would try to get you in touch with an attorney whose specialty is this. You just don't want to go to your run-of-the-mill attorney, though, because if it's handled improperly, if the trust receives the IRA assets, you could get hit with a big tax, or your heirs could get hit with a big tax, and it kind of defeats the purpose of what you're trying to do. Does that make sense?
Yes, it does. Thank you very much, Josh.
So I hope that helps. The benefits of the see-through trust is that it allows the oldest of the individual trust beneficiaries to be treated as if he or she were named directly. If the trust does not qualify, and this is where it can be tricky, if the trust does not qualify as a see-through trust, then the IRA will be treated as if there was no beneficiary, and the post-death payout will not be based on a beneficiary's life expectancy. It will be based on the rules that apply when there's no beneficiary designated. And the Secure Act changes that. So in some cases, it may be just better to name the grandkids, and there is a risk there. I mean, you don't want minors to piss away the money. So I'm not saying don't do it. I'm just saying after the Secure Act, it's way more complicated than it used to be. Next up, we have Monica. Go ahead, Monica. You're on with Josh Jelinski, the financial quarterback. And folks, if you have a question, our whole hour is devoted to your questions at 800-321-0710. Go ahead, Monica.
Good morning, Mr. Josh. How was my son doing today?
Good morning.
My baby son. How is he doing?
Well, we'll see. Yeah. Pray for my baby. Still in the hospital.
Yes.
So.
How is he doing?
He's doing. We got to pray he holds his temperature. He can breathe on his own and eat on his own. That's what we got to pray for. So.
Good. Amen.
Yeah, he's alive, thank God. So thank you. You're a sweetheart.
Thank you. Anyway, my question is, why can I get one of those institutional low interest rates? Because I went to bank rates, it's 5% and 6%, and the interest rate is like 2 and 3. Why can I get one of those low interest rates and also a low car loan for car? Interest rate for car loan also.
You want a low interest rate for a home refinance and a car refinance, or what?
No, not for home. I just for personal loan.
Well, personal loan rates, I looked the other day, and we're not recommending you buy or sell anything. Did you go to bankrate.com?
Yes, I did.
Somebody was telling me personal. Number one, you Google personal loan rates, best personal. Well, I'm going to Google it right now, see if I find best. I think one of the Republic banks has one, something I saw at like 2.25 or something. No, I'm
really?
not. I'm looking. There's a bunch. SoFi is 5.99 right now for their personal loan. I saw something else. Somebody just said Navy Federal Credit is 1.79. That's not bad. Check Navy Federal. Although you might, I don't know, if you need to be. There was one of these banks that somebody was telling me. Lending Tree rates as low as 2.49 they're offering. Nerd Wallet has some rates. Marcus by Goldman. There's if you do best personal loans of August 2021 as your search term, you should find stuff. They're ranging, it looks like, from about 2.5 to about 5.99 if you have decent credit. It's a company called Lightstream that's offering something, but we're not recommending you buy or, I don't know and can't speak or vouch for any of these people. I'm just trying to help our listeners. There was some bank, I want to say like Republic Bank or something. You could also get a loan against your portfolio if you have stocks. We were finding rates in the 1.79 range where you could get a loan against your portfolio. That comes with certain risks, like if the stock market goes down, you might have to have a margin call. But there's a lot you could do in today's low interest rate environment. But you're right. It used to be you could get a personal loan so easy. and now they jacked the rates up. You know why? That's because of all the credit card, and the credit card industry told us this. They said they passed all these, supposedly consumer protection laws that forced credit card companies to do X, Y, and Z. I don't know about you, but credit cards are still charging a lot of interest. But what they did is they stopped a lot of the ways for normal people with good credit to get very low rates. So you got to shop around a whole lot more.
Mm-hmm.
And so as far as car loans, you may want to check your local credit union.
Okay.
So a credit union usually gives you a fair rate.
Mm-hmm.
And also check your credit card company.
Mm-hmm.
And there's a lot of places right now that are offering really low rates that you may want to take advantage of. So we have to, any other questions, Monica? This was fun.
I'm also, anyway, it's a long question, but I have nothing to do. Where can I go? I want to steal Capital One Bank because I have a credit of $850, and because I always pay my bill all in full, it doesn't matter what the amount.
Sure.
And I used to have a Capital One Bank. I was with them for like 10 years, 15 years. I never missed a payment. And then I didn't use my card for a long time because they did something that I was uncool. It was their fault one time. And so I said, okay, forget it. I'm not going to use it anymore. So I didn't use the card for like a year. And all that time that I have like a 21,000 or 22,000 miles with them, So, and recently I said, let me check to see if I can clear them out. And then when I went there, they said my account has been deleted, and I called them and I said, why? What they told me is we deleted your account because you are delinquent. I almost went through the roof. Me, delinquent, for what? So because of that, I lost my amount.
Well, what you could do is challenge that with the credit agencies. So get a copy of your credit report, and if there's anything negative on your credit report, you can dispute that. So I hope that helps you, Monica. Thank you so much for listening, and thanks for watching on the YouTube. So folks, go to youtube.com and search for Josh Jelinski, the financial quarterback. And up next, we have more of your questions at 800-321-0710. And thanks for caring about the baby with the baby update. We got Monica with the baby update. This is Josh Jelinski, the financial quarterback. Don't touch that dial.
Are you worried about the recent coronavirus crisis and how it may have affected your money? Hi, everybody. I'm Josh Jelinski, the financial quarterback, inviting you to join me for my complimentary 6 Ways to Keep Calm During Turbulent Markets webinar. If you schedule and keep your no-obligation webinar today at 888-988-JOSH. It's a great thing to do if you're stuck at home under stay-at-home orders. Call us right now, 888-988-JOSH. If you're bored, there's never been a better time to get a second opinion on your wealth than right now. 888-988-JOSH, 888-988-5674. And go to my website, retirementrealitycheck.com today and take your free investment profile quiz. And when you buy my book, you're eligible for 3 free gifts. 888-988-JOSH.
Call Josh Jelinski, host of the popular Financial Quarterback radio program. 888-988-JOSH.
Josh Jelinski, the financial quarterback here. In these uncertain financial times, it is imperative that you guard your financial future. If you call within the next 3 minutes, we will offer our complimentary bear market survival guide, which will detail steps to help your plan to potentially survive the COVID-19 crisis. The bear market survival guide will cover how you might still be able to retire amid a volatile economic climate. We will throw in our complimentary 27-point ultimate game plan for retirement. Call us at 888-988-JOSH, 888-988-5674 for your bear market survival guide.
Call Josh Jelinski, host of the popular Financial Quarterback radio program. 888-988-JOSH, 888-988-JOSH.
Hi, everybody. We're back. We have a question from YouTube.com. Search for The Financial Quarterback on YouTube, and you'll see my ugly mug. Hit the subscribe button. And we have Pat who says, sorry I was late for the annuity segment. Well, that's the beauty of YouTube. You can go back and watch it. Is it typical for the principal in an annuity to freeze when you start annuitizing it? It may, and that's why you may want to consider non-annuitized annuities. The old saying was annuitization is annuicide to your principal, meaning like when you annuitize, you're kissing the rights to your principal goodbye. It doesn't sound like yours is exactly true annuitization. In true annuitization, you give the principal rights back to the company and you get an income for as long as you or your spouse or for a set period of time. So I hope that helps you, Pat. If you have any follow-ups, be sure to call us at 888-988-JOSH. We would love to hear from you or any of our listeners if you call us at 800-321-0710. And that's why some of them charge a fee. You're basically buying what's called reinsurance. So if you live longer than life expectancy, the insurance company doesn't go under, basically. Investment News is reporting that we need a retirement task force. Do we really need another government entity to require retirement security? Failed programs like Social Security prove the government has no place in your retirement strategy. So there's a lot going on here, and I'm a little concerned for those of you who, I don't know about you, but is a retirement security task force a good thing or a bad thing? I want you to answer that with me. Is a retirement security task force a good thing? According to Mary Beth Franklin, who's been a popular guest on the program, more than 30 leading voices in the retirement industry released a letter urging Joe Biden to issue an executive order to create a standing interagency task force on retirement security. Do we really need another government task force? And you notice the companies are urging him. Why? Is it because they're going to get some extra business out of it through it? So the letter was, who was it signed by? From all these. Now, mind you, I believe retirement security is a problem. But all these companies, ADP, even Prudential, Saver Life, TIAA, Third Way, Commonwealth, Alliance for Lifetime Income. So why do we need private companies to petition the government for more money? Now, if you want expanded, tax breaks or the protection of the 401k or some type of program that incentivizes people to save their own money, I'm all for that. But it just always worries me. It's like a lobbying type of thing that I don't know if it's needed. What say you? Mike, using a brokerage option on a company 401k. We'll talk about that next. Go ahead, Mike.
Yes, hello, Josh. I have a question for you. I have a 401k with my company, and they offer a brokerage option on it. And from talking to other people have taken money out of their 401k and have bought stocks with a particular investment company. I just wanted to know, they said it would be treated as ordinary income. Is this a good idea or is this a bad idea to take money out of your 401k? I know the taxes you would be taxed instead of it being in a 401k where it wouldn't be taxed.
Well, it would still be taxed. The question is it like what's called brokerage links? So we, in partnership with Fidelity, and we're not owned by them, but we work with them as a custodian on certain 401ks, where if you have a Fidelity 401k, we can help manage that through a process called brokerage link. Then you don't have to pay any extra taxes. You can have world-class professional guidance. We could help you with buying individual stocks, index funds, mutual funds, no-load funds, And you don't have to leave the 401k. So some programs have that. That's called brokerage link. Schwab has another thing that they call it similarly. And basically, you can keep the tax deferral and not get the big tax hit. If you're saying, people are saying, take your money out of your 401k, pay all this tax, and then put it in a taxable account, well, I don't know if that's necessarily a good idea. I would have to get to know you, what you're trying to do. It would be better to if you're going to pay the tax and have it go into a Roth IRA. That way all the future growth is tax-free. But it sounds like you mean just pulling money out of 401k and just putting it in a brokerage account. But the brokerage account still has taxes on gains. It's just not tax deferred. So I don't really understand what people are encouraging you to do. Do you know?
Well, I know that the advantages of 401k is that you're not taxed until after you sell everything. But the point is like, say, for example,
you're not taxed till you're 72. You can buy or sell stock or mutual funds within an IRA without paying tax. It's when you hit 72, you have to take out a required minimum distributions. Or if you need money before 59.5, there's a 10% penalty plus income tax.
Correct.
So maybe they're saying to tax that capital gains taxation is better than income taxation. I don't know what they're getting at.
No, I think from what I talked to different people, what their point was, say I don't have the capital in my hand to purchase an Amazon and buy, 50,000 shares of not 50,000, but say 10,000 shares. I can't afford that out of my own personal income. But if I take it out of my 401k, now I can grow that money with a Fidelity Link account. That's a brokerage account that's linked with us.
You may be able to do that. I would call us at 888-988-JOSH before you make a mistake, because it was worrisome when you said that you might have to pay the tax on it to go into a taxable account.
Okay.
But you may just be referring to the brokerage link concept where you don't pay any tax and you can buy whatever you want within the universe.
That's what they told me, that I don't have to pay taxes on it if I take my money and put it into, whatever I wanted to use the money for as far as stocks are concerned.
Yeah, it sounds like brokerage link. I would call us. We could call your 401k company with you, see if it's available, and make sure there's no tax consequences.
Okay.
The thing you'd also want to look out for is when buying individual stocks, you want to make sure you're properly diversified. So if one stock goes under, you don't get, you don't lose a ton of money. Okay.
Well, I'm well diversified in my 401k. Just I wanted to have the opportunity to purchase, like we just talked about with your program,
shares
was talking
of
about,
something.
like
Sure. Yeah.
buy an Amazon or something like that, where they're going to be around forever.
Yeah. Well, that's what they said about Sears. So you always want to be careful when buying individual stocks. So I remember I did a show one time that, I think about 100 years ago, the Sears catalog was like Amazon.com.
Right.
If you went back in time 100 years and you showed people Amazon, they'd go, I don't need that. I got the Sears catalog. Remember, I remember in the 80s, 70s, you would circle what you wanted.
Yeah.
From like the best catalog or the J.C. Penney, and then you'd show your parents, hey, this is what I want for Christmas. And in some ways, what if we go back to the future? What if that's the new, like a digital catalog? Because in the era of just over inundation with sales online, maybe people will crave that. So no doubt the Sears catalog must have been inspiration for Jeff Bezos with Amazon. Because if you think about it, Sears, you used to be able to buy like Craftsman tools, get your tires done, buy blue jeans, buy a shirt. It's kind of like Amazon. You can buy virtually anything. But that was thought of to be like the paragon. And then Sears went belly up, and now Amazon's rock and rolling. So always be careful when buying individual stocks. So great question, Mike. And then we're going to go to Dan and Jerry. Jerry has questions on TODs, taxes, and dividends on death. Also, Dan wants to know about buying preferred stock and gifting his kids from his portfolio. And we'll talk about more when we return. But first, call me 888-988-JOSH right now for the 45-minute ultimate financial game plan. We'll show you different tax savings strategies, asset protection strategies, and growth strategies in these uncertain times. So call us 888-988-JOSH, 888-988-5674. We'll be back after these messages.
It's always on your mind. Retirement, whether you're 55 or 35. Not everyone wants to work forever, and most would like a comfortable retirement. You may already have a plan, but is it the right one? Josh Jelinski, host of the popular Financial Quarterback radio program, is ready to guide you towards financial freedom. He challenges the ways your parents and grandparents saved money with fresh strategies, which are exactly what you need to navigate today's volatile economic climate. Josh's new book, Retirement Reality Check, is available to order on Amazon. It's an easy read that guides you through his system for securing your financial freedom, including tax-saving strategies, understanding the right investment mix, and more. Order now. Retirement Reality Check. Call Josh at 888-988-JOSH. Let Josh help you map out your retirement using fresh strategies. Call 888-988-5674. That's 888-988-5674.
Okay, we're live, taking your calls at 800-321-0710. If you have a financial question, call us now. This is your show where we get to ask any and every financial question you have. Also tomorrow, Saturday, Sunday at 9. Check out the YouTubes. Search for Josh Jelinski, the Financial Quarterback. Hit subscribe. And if you miss a show, you get to watch my ugly mug on YouTube. Next up, we have Dan. Go ahead.
Yeah, good morning. Thanks for taking my call.
Hey, how have you been, Dan?
Okay, pretty good. Nice hearing your voice again. Buying a new, and that's the key, new preferred stock, a place that I'm dealing with claims that I cannot do it there, and I like to add it to my holding. Any idea how I can go about buying it?
Well, preferred stock, you can buy any preferred stock at any brokerage company. Just instead of having your money at the bank, put it at a brokerage company. Call us, 888-988-JOSH. We can first do due diligence to see if it's right for you. Second, give you freedom of investment options with world-class brokerages. We work with companies like Fidelity, Schwab, Interactive Brokers, and whatever is best for the client. So E-Trade. Does that make sense?
Well, it sounds great. Okay, the only thing here, people I'm working claiming that they don't offer it. That's why I was wondering if I wanted to go and branch on my own, how would I go about it? Okay, so you suggest to get in touch with your company, and I can do it through you.
Yeah, 888-988-JOSH. Yeah, any broker should be able to find a preferred stock. So.
Okay, well, I wish it was so simple. Okay.
Yeah.
All right. Okay, well, my other question is like this. Okay, it might sound strange, okay, but I know what I need at this point of my life, and I have 2 adult children, and I like to gift them some of my portfolio. Now, I know about the $15,000 a year, but I'm talking substantially more than that, okay, and I trust them, okay, and in either case, if they want to blow it, where they're going to blow it, while I'm alive or after it, it's their choice, but I trust them, so is it smarter to just leave it alone, and when I die, they get the money, they get the cost base and all this, or let them have it earlier, okay, or at least part of it? Any thoughts?
Well, you can give $15,000 a year per kid, per spouse, so $30,000 each.
I'm talking about
without the annual gift tax applies. No, I know what your question is. I'm just giving. But you can also have what's called the giver's lifetime gift tax exemption. So you could give $1 million as long as you file a gift tax return. Does that make sense? They could get whatever amount you want to give them up to a certain amount without gift taxes.
Now, do you pay taxes on those?
No.
Only if you give it more?
No, you just have to file a form.
Okay, so when you file your taxes, you also file a form?
You would only pay the tax if your assets were like north of 24 million or something.
I wish. No.
So if it's 11.58 million was last year's gift tax threshold. So per spouse, it's 11.7 million this year, 23.4 million as a couple, and then any gifts above that would be taxed at a 40% tax rate.
What about as far as state and local taxes?
Well, state and local may have their own thing. Your state may have a $5 million threshold. We'll help you walk through that when you call us at 888-988-JOSH for our gifting strategy session. 45 minutes with yours truly, 888-988-JOSH. Also, what are other considerations? Should you gift it or should you let it grow and then them get a step up in basis? Well, it depends on how much you're worth. If you're worth like in that 23 million range, you should definitely do the gifting because they're probably going to change that with the Biden tax code. But let's say, you're like, oh, I got $500,000, $1 million I want to give to them. You may want to grow that in something like a Roth tax-free for 10 years. You may want to grow that in stock. That way they get a step up in basis. Now, we don't know if the step up in basis will be around forever, but it currently is. And then if they ban the step up in basis, then you do the gifting strategy. So it's not merely enough to gift. You want to gift with a plan. And also, you might trust your kids, but what about their spouses? So that's why you may want to even set up a trust or dynasty trust. That way, when your spouse dies, the money doesn't go to your in-laws, your son-in-law, it goes to your daughter, and then when she dies, it goes to your grandchildren. Because if you leave all the money to your daughter, she dies, it could go to the son-in-law, which you may want that to happen, but it's just something that some people don't want to happen. So we explore all the ways to leave your money to the people you love and the causes you love. So call us for the 45-minute strategy session. 888-988-JOSH. Any other follow-up questions, Dan?
Thank you so much, and have a great day. And again, nice hearing you again.
Thank you. Great to hear you again. And you got to make sure, if you miss any of the, I know you're a loyal listener, Dan, you want to make sure we got the YouTubes. We're on Spotify. We're on the iHeartRadio app. So if you miss any episodes, we do 3 live hours every weekend. And now we have even a new bite-sized snippets called Financial Quarterback Inside the Huddle, which can be found on Spotify. It takes the best of the shows, cuts out any commercial content. A lot of people like that, so you get like a daily nugget of information every day. Cal does a great job putting that on. So thanks so much for the call. Next up, Jerry, TODs. What does TOD stands for? Transferable in death. Go ahead, Jerry.
How you doing, Josh?
Thank you for the call.
Okay. Josh, I have a TOD account. When I die, do any taxes have to be paid on transfer on death, or is that deferred until the stock is cashed?
Well, it depends on what you're worth, and it depends on what asset.
Okay. All right. You answered the question there. All right. The other question that I have is
if you have, let's say you're less than 24 million, and you don't have state tax to worry about, and you have stock in Berkshire Hathaway that you bought 20 years ago.
Yeah.
I own it for the interest of full disclosure. Not recommending you buy or sell it. I'm just saying, just using a stock name.
Yeah.
So you buy 100,000. Today it's worth 400,000. You bought it 20 years ago. You die, your heirs wouldn't pay tax on it, on the 100 growth to the 400, because they get it with a step up in basis. Now, once they inherit it, then they would pay interest, dividends, and capital gains, which Berkshire doesn't pay any dividend tax, so you wouldn't pay tax on that.
I got you.
Let's say they inherit it August 1st of 2022. Hopefully you don't die in a year. And then they don't sell it for 5 years. Well, then they would pay tax on the 5 years of growth, but not your growth, unless you gifted it to them, which this kind of ties into Dan's question. Sometimes if your focus is legacy and giving money to your kids, you don't want to gift it because then you're going to gift your tax burden to them.
Okay.
Well, one of the beautiful things about owning stock or ETFs is when you die, they get a step up in basis. And although Biden is saying, I want to get rid of that, he's saying it for only a certain type of person, if you make over $1 million. Now, eventually they're going to get rid of it for everybody, is what I guess the angle is. So they're trying to get used to people paying it. But, rather than just say, well, we're only going to affect trillionaires, you know what I mean?
Yeah.
So give us a call, 888-988-JOSH. Thank you, Monica, for praying. Wow, I just got a text from my wife. They moved him down to 1 liter of oxygen, and he's nursing. And that would be great. So keep praying. Free the baby from the hospital. So what other questions do you have, Jerry?
Yeah, Josh, one other thing. I have it set up where dividends are reinvested into the TOD. When I die, does that automatically continue on the TOD? Well, it doesn't because the TOD is transferred, I understand that. But do the dividends still continue that way, or does the TOD have to set it up?
Most brokerages will freeze the account upon death.
Okay.
So your heirs have to deal with it. Now, I don't know if they continue reinvesting dividends or not. Theoretically, I guess they don't, but could happen, I guess.
Okay, you have to. They'll have to check on that themselves.
That's why a lot of people, if you're a self-manager, and let's say your kids aren't or your wife isn't, you say, hey, you know what? Call 888-988-JOSH, and Josh will help you.
All right, very good.
Because
Thank
a lot
you
of
so much.
people too who listen to the show, they're really knowledgeable, but their spouse isn't, or their kids aren't, and that's one reason to hire a financial advisor before you go. That way, it's all set up seamlessly. Because you don't want them to mourn, and we've had too many people, and for some reason this is peculiar. It is never the planning spouse that goes second; they always go first. And I wonder if it's because they're a Type A personality, they have the heart attacks, all that stuff. Not to be joking, but typically, the one who's left is not as into the finances. So we sometimes have to spend like a year educating people who've inherited money. Yes, you're going to be okay. Here's what they've set up. Here's the taxes. And that's something that we'd be happy to help anybody if you're going through that, or if you want to make sure your heirs don't go through that. They have the right people to go through. Give us a call at 888-988-JOSH. Any other questions, Jerry?
Well, I just said I don't have to worry about that. I'm single, so I don't have to worry about that at all.
Well, that's a good concern, but also you do have to worry about it. Here's why. If you have highly appreciated stock and you pledge that money to charity, you can get massive write-offs. So that might be something you look at doing, and then use those write-offs to convert IRA to Roth money, and then your heirs or your niece or your nephew, they'd get the money tax-free on the Roth, and then you would be able to give to charity. So there's a lot we could help you with. Give us a call, 888-988-JOSH. It's the Tom and Jerry Hour, because next up, we got Tom, who wants to know about how to defer taxes on H and H bond cash-in. When we return, if you have bonds, listen up. If you have money, listen up. 888-988-JOSH. We'll be back after these messages.
Hey, meet you out on the first tee?
Yeah, I'll be right there. Just reading this article.
On what?
New bill Congress passed. Looks like it's going to affect the value of all retirement savings plans. My financial guy didn't tell me about this when I saw him the other day.
Well, my guy did, and we made a plan. You may have heard of him, Josh Jelinski.
Josh Jelinski is your guy?
Listen, if you're 10 years or less from retirement,
which I am,
Josh will give you a free economic plan, which includes retirement planning, a 27-point checklist to make sure your income lasts as long as you live. He'll even help you navigate the current tax code.
I'm definitely going to call Josh.
Cool, but first, can we play some golf?
Call Josh Jelinski, host of the popular Financial Quarterback radio program, for your free economic plan. 888-988-JOSH. 888-988-JOSH. 888-988-JOSH.
Are you worried about the recent coronavirus crisis and how it may have affected your money? Hi, everybody. I'm Josh Jelinski, the financial quarterback, inviting you to join me for my complimentary 6 Ways to Keep Calm During Turbulent Markets webinar. If you schedule and keep your no-obligation webinar today at 888-988-JOSH. It's a great thing to do if you're stuck at home under stay-at-home orders. Call us right now, 888-988-JOSH. If you're bored, there's never been a better time to get a second opinion on your wealth than right now. 888-988-JOSH, 888-988-5674. And go to my website, retirementrealitycheck.com today and take your free investment profile quiz. And when you buy my book, you're eligible for 3 free gifts. 888-988-JOSH.
Call Josh Jelinski, host of the popular Financial Quarterback radio program. 888-988-JOSH.
Okay, we're back. This is Josh Jelinski, the financial quarterback. And if you're a musical, let's say you're into music, share your music with the broader listening audience, we'll feature it on our YouTube. You got to allow us the rights. We will be featuring local artists in coming months. And then every Sunday, because we don't do the YouTube show, we play your favorite oldies hits. Next up, we got Tom. Go ahead, Tom. We had Jerry, now we have Tom.
All right. I have H&H bonds. They stopped paying a dividend. If I cash them in, will I have to be subjected to taxes, or can I get at the bank where the bonds are stored, transfer them over to I bonds, which I read somewhere they were paying 3% plus?
Well, generally, you have to pay tax on H bonds. Your interest is earned every 6 months, and the bond interest is taxable but not subject to state or local taxes. You may want to gift it. You may want to use it for college. There's different things. But generally speaking, you owe tax. And I get people who call every year with like savings bonds that aren't earning any interest. You're giving the money to the government with 0 interest. So I would pay the tax. Just be done with it.
Yeah, because it's up around $30,000, and if it goes on to my normal taxable, that my tax preparer says I'll really be up in a higher bracket.
Yeah, and, but don't let the tax tail wag the dog.
Well, that's what I'm worried about, and I'm no spring chicken anymore. I don't have that much time to really go long term.
Now we'll look in. I mean, there are some other ways to gift them for college and all that type of stuff. That some people are experts on, so we could research into that. But generally, if you just wait till you die, then there's going to be taxes due on the estate. I would just personally, I would cash in the bond, eat the tax, but I don't know you well enough yet to make that determination. So call us at 888-988-JOSH, and I can help you through that, okay?
Yeah, but, I was the small dividends that was paying, that is reported on my tax when I do file it.
Oh, you do pay. Oh, well, so maybe you've paid taxes all over the years.
Well, I've been paying, it only pays like $500 some odd dollars for the year, according to my tax return.
Well, maybe there won't be any tax if you've been paying tax all along the way. So
who could I confer that with?
Well, we'll discuss your case with an accountant. I'm not an accountant, but we'll refer you to one if you need one.
Yeah,
okay?
Because I asked my guy, and he said he doesn't have the answer for me.
Well, you look up. I mean, there's different IRS publications. I mean, I'll also look up stuff to help you. Okay?
Is it possible to transfer those bonds without any problems to an I bond if they're paying that 3%?
Yeah, I'm not sure. I have to look into that. So my recommendation would be to call us, 888-988-JOSH, and then we'll give you a free 45-minute ultimate financial game plan, and then we'll try to link in your accountant or get you a new one if they're not willing to do the homework. Okay?
Thank you very much. I appreciate it.
I'd love to meet with you. You can call us at 888-988-JOSH for the free financial review over the phone, over the web, or in person. 888-988-JOSH. 888-988-5674. And if you call us within the next 3 minutes, you'll get 3 free gifts. Number 1, the 27-point ultimate financial game plan. Number 2, the on-point risk analyzer. Many of you are being lulled to sleep by the siren of market serenity. And you think, oh, with President Joe Biden at the helm and Congress, everything's going to be good for the next 4 years. The market's going to go up. But then all of a sudden the Delta variant comes. So what about Delta variant? What about what's the next? There's some other problem that happened this week. Inflation. There's like a ton of things that could go wrong in this market. Are you prepared for market uncertainty? Get the on-point risk analyzer. That is a tool that will assess your portfolio's risk. But you got to call us. 888-988-JOSH. And you get those 3 free gifts: the Maximize My Social Security Review, the On-Point Risk Analyzer, and the 45-minute Ultimate Financial Game Plan. We go over 27-point checklist. 888-988-JOSH. We'll be back after these messages.
It's always on your mind. Retirement, whether you're 55 or 35. Not everyone wants to work forever, and most would like a comfortable retirement. You may already have a plan, but is it the right one? Josh Jelinski, host of the popular Financial Quarterback radio program, is ready to guide you towards financial freedom. He challenges the ways your parents and grandparents saved money with fresh strategies, which are exactly what you need to navigate today's volatile economic climate. Josh's new book, Retirement Reality Check, is available to order on Amazon. It's an easy read that guides you through his system for securing your financial freedom, including tax-saving strategies, understanding the right investment mix, and more. Order now. Retirement Reality Check. Call Josh at 888-988-JOSH. Let Josh help you map out your retirement using fresh strategies. Call 888-988-5674. That's 888-988-5674.
We're back, folks. We had a very fast-moving hour. A lot of questions. But what about your questions? Maybe they're unanswered. Maybe you're concerned about the economy. Call us, 888-988-JOSH. And is the Retirement Security Task Force a good thing? I don't really want the government. We have had the government take over of healthcare. We had the government take over of medicine with HIPAA and all the HMOs in the 90s. The government takeover of retirement security could be a bad thing. Now, I get what the coalition is calling that for. They're calling for there are people who are ill-equipped for retirement. So their probably heart's in the right place. You know, people are really not saving enough as a general population. Our listeners save. But I get what they're saying. You don't need some task force to save you for retirement. You need to be financially literate, and you need a well-educated, independent fiduciary like what we provide at Wealth Quarterback, our fiduciary firm. Call me right now so I can help you formulate a more secure retirement. Now, the coalition is right. There are many hurdles that lie in the way of a successful retirement. What could those hurdles be? Death, disability, unemployment, dismemberment. I want to say death and dismemberment. I like seeing those two together. But long-term care, illness. I made a choice today. I said, you know what? I have an HSA. I was going to pay for some health bills. We have all these health bills piling up. And we have these health bills, and I have a choice. Pay them or pay them with my HSA. And I was going to pay them with my health savings account because money is going tax-free on the way in, grows tax-free and can be pulled out tax-free. I chose to pay them individually to let my HSA compound over the next 20, 30 years, because that might be really when I need it. Maybe I'm not going to do this forever. Although, thank the Lord, you know, we've accumulated enough where I could retire if I wanted to. So, vaccine mandated retirements are here. There's a lot of people who are forced to be vaccinate or retire. Others who are immunocompromised in their work environment is not mandating vaccines are choosing to retire early. Bottom line, if you had to take the vaccine or retire, would you? So here's the thing. Whatever it is, vaccine or retire, you have different companies like Google, they're mandating the vaccine to have people go back to work. That's up to you. Your medical choices are up to you. I don't really want to get into a vaccine debate. What I do want to talk about, though, is are you set up to retire? You have to be in charge of your own financial security. This is why you save. This is why you need a bunch of money saved for retirement, so you are not forced to retire. And if you are forced to retire, because maybe you don't want to take the vaccine due to health issues or whatever, religious exemptions, whatever, or maybe you just don't want to do it, you don't have to retire if you don't want to. So this is what this got me thinking. People are not ready to retire. Are you ready to retire? Call us right now for the Retire Now conversation. That's 45 minutes with me. 888-988-JOSH, 45-minute ultimate Retire Now
program
conversation.
was sponsored by the Jelensky Advisory Group. Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jelensky or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jelensky.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jelensky and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Investment advisory services offered through Wealth Quarterback LLC.
WOR and WAXQ HD2 New York, an iHeart radio station. Available everywhere on our free iHeart Radio app. #1 for music, radio, and podcasts.
The information you need